Hey Eric, how are you? So
Can you
I'm
hear
going
me
to
all
ask
right,
you,
Dale?
got you, buddy. Welcome to Face. Very nice to meet you.
Thanks for having me. Appreciate it.
All right, so if you want to share your screen, it's that little green box drop-down menu. See it?
All right.
Yeah, here it comes.
Can you see me?
Okay, got it. Looks like you prepared. You have
Well,
PowerPoint here.
yeah, I actually just finished presenting my quarterly, so I figured I'd pull up the slide deck, and wherever the
Okay,
conversation goes, I likely have a slide for it. So
all right. Well, really great to meet you. I'm always interested in the journey and the road that you took to get from point A to B where you are now. Can you tell us a little bit about, maybe what you were doing before you got into the business and how you got into the business?
sure. So my quick background: I was involved in markets from a young age, was sort of in the family. Studied economics at New York University. Took courses in financial crises, money and banking, econometrics. Did kind of odds and ends jobs around the street as I was in school and graduating. Then I jumped over straight to the buy side and worked at a quantitative fund in Midtown called Panorama Partners. And they had some interesting quantitative strategies using long dated options on triple levered ETFs. It was a great experience to work there. However, it was a little bit out of the realm of the economics background that I had. So while I was there, I continued studying economics. Most of my studies were in the long-term impacts of debt deflation, demographics.
Okay.
Um, but being on the buy side, I had an appreciation for the fact that a 3 to 5 year outlook is sort of a unique position to be in, and not a lot of people are able to take that time frame exclusively.
Hmm.
Most people need to mark performance on a monthly or quarterly basis.
Yeah. So
So
you
I also
use
began.
you use a telescope
That's right.
instead of a
So
microscope. Yeah. Okay.
yeah, so I began to also augment that work with some of the what I would call business cycle leading indicators. So getting an idea of where the economy is heading over the next couple of quarters, rather than just the next 3 to 5 years. Anything shorter than a couple of quarters is sort of your domain with the trading and the
Hmm.
charts. I don't really go any shorter than a couple of quarters. But combining the long term, what I call secular trends, these 3 to 5 year, 10-year trends in the economy, with the business cycle indicators giving you a quarter or two heads up of where the economy is heading, is a nice balance, which can give you great insight into which asset classes are likely to outperform. And
Okay.
that blend of long-term secular trends and shorter-term business cycle trends was something that I was not seeing while I was at the fund in terms of research that was available. So in 2016, I left that fund to start publishing my own research on that exactly. It's been over 5 years now. It's been going well. So
Okay.
that's sort of how I got to this point now.
And now you produce this letter. You have subscribers and uh, retail and institutional, Eric.
That's right.
Okay, so why don't I start with something recently that's happened, and I'm curious if you think it's secular or cyclical. And we've had this shift once yields started to move up from growth to value. And I'm wondering if you think this is just going to be, and a lot of people talking about the inflationary pressures because of what the Fed wants to accomplish, all the printing. Yet there are still very few left of the deflationists out there. So why don't you tell us where you think we're at, Eric? I'm looking forward to your views, hearing your views.
Sure. So um, I always start with I am in the long term disinflation camp, and I always start with this chart of nominal GDP per capita. And the reason I start with this is because this is a nominal series, so we can avoid the debate over whether the CPI is measured accurately or not, because this is a nominal series.
Okay.
And what we see here is, I was writing a couple notes while some of the speakers, forgive me, I don't recall all their names, but why are all the Fed chairmen and chairwomen doves. Why do they come in there and think that something different is going to happen, but they all turn to doves? It's because of this chart right here. No matter what they do, they step in and there's a quarter or two or maybe a year or two of strong growth, but then it immediately turns back down and they cannot get out of the way of this secular decline in long-term nominal growth. If we flip over to real growth, we see the same thing. Real GDP has been in a continuous decline where over the last 20 years, real GDP per capita has only increased at 0.9%. That's with the reported CPI. So if we agree with the consensus that the CPI is radically mismeasured and inflation is really 3, 4, 5%, then you'd also have to concede that real growth has been negative for basically the last 30 years, which I don't particularly agree with. I'm more in the camp that the CPI is fairly accurate. And the reason that we have a debate over whether the CPI is accurate is because, as this chart shows, real growth has only been 0.9%. And this is an average. We all know that in the United States, we have a tremendously large wealth gap. So what this means is that there's certain people that are growing at 5, 10, 15%, and then a ton of people that are below zero. And the average is 0.9.
The K.
Exactly. So we are in a situation now where with such a large wealth gap and such a low rate of real growth that it's entirely possible that 50, 60% of the population actually has a negative growth rate, which leads people to believe that inflation must be higher than it's reported, when really it's just that the growth is distributed towards one side and the average is not really representative of a majority of the population anymore. But this is the way it's reported. So the reason that this is coming down is because of two things. Long-term growth is a function, demographics and productivity. Productivity can be proxied via debt. So this is the chart on debt. What this shows is this is the semi-annual change in GDP and the semi-annual change in debt. So what this chart means is that if you go back to the 1960s, if you could see my cursor over here, what this means is that for every dollar of debt that we were taking on, we were generating almost 80 to 90 cents of growth. And this is not just government debt. This is government, business, and household debt. Over time, this has obviously come down quite dramatically to the point now where we're generating 20 to 30 cents of growth per dollar of debt. And our solution to this problem is to try and take on more debt.
More debt.
And exactly.
You know, Eric, I have a demographic question because,
Please.
I used to read things. Harry Dent's one of the guys I've interviewed for a long time, and his bearish argument for real estate, he says, houses don't die, people do, right? And stock market bearish view was because of the demographics. And over the last few years, I've been hearing that there really isn't a demographic problem because the millennials are even as large as the baby boomers who are going to die off. Can you straighten me out on where you think the demographics are here in the U.S.?
Sure. So this chart here, the demographics are a problem. However, the problem in the United States is a lot less bad than the problem in Japan, Europe, United Kingdom, and even China. So as far as the major economies, the U.S. has the best demographics going forward, but it's worse than it was years ago. So with everything in economics, it's always relative to where it's coming from. So if I told you that growth in the was going to be 3%, and that was all the information you had, it'd be tough to make a forecast, a judgment of where it is, because if growth was going from 0 to 3, that's different than if it was going from 10 to 3.
Yeah, so like China.
Exactly. So this is the chart here in the United States of the population growth. The population is getting older. We have a age dependency issue where we're going to have a larger cohort in the older population that has to be supported by the younger population. And what's surprising about this chart is we hear a lot of what's going on in the United States now, similar to the Great Depression in 1940s era, where the Fed did yield curve control and we sort of solved our debt problems. And what's missing from that conversation is this piece right here, where we had the largest demographic boom basically the world's ever seen. where population growth went from 0.6% to 2.2%. Now, if we know that growth is a function of population and productivity, right off the bat, we had higher population growth than we do total economic growth at this point. So the idea that we're going to be able to replicate the results from the 1940s with similar policies is not accounting for the fact that population growth has fallen from 2.2% to right here where we are, where the line changes color, is about 0.6. And then the estimates are going to drift lower. But what's interesting is that by the end of the century, we still have positive population growth, whereas Japan currently has negative population growth and Europe has just crossed into negative population growth. So the situation in the United States is getting worse, but it's getting worse at a mild rate, whereas the situation in Japan, Europe, United Kingdom the slope is a little bit sharper. So we are going to have a headwind in terms of economic growth from lower demographics, but that doesn't necessarily mean that asset prices have to follow. That sort of wanders into the realm of monetary policy and things like that, where we're deciding to attempt to solve the situation with tons of excess liquidity. None of that liquidity tends to make it into the real economy. That liquidity tends to slosh around in financial markets and financial assets, which can cause those assets to deviate from their underlying economic fundamentals.
Well, isn't that what we have happening with cryptos and what are those things called? There's all the NFTs.
That's exactly my opinion, is that I'm not too familiar with the ins and outs of the cryptocurrencies, but my general view is that they're mostly a take on excess liquidity in the financial markets, where if we run money supply growth at 20%, a lot of people fear that that's inflationary. Well, we have to look at velocity also, because that's how we get nominal GDP. And despite the fact that we had money supply growth of 20, 30%, nominal GDP didn't budge because it was offset by velocity. And what that velocity tells us is that money supply is not making its way into the real economy. So this is the velocity. Velocity's fallen to the lowest level in 100 years. Money supply growth is also at the highest level in 100 years. Basically, what that tells us is that nominal GDP is being totally neutralized, but we have a ton of money sloshing around. None of it's sloshing around the real economy. It's all sloshing around the financial economy. And that's where it flows into assets like Bitcoin. And I would call real estate and blue chip stocks your primary assets, things that have a legitimate cash flow that you can value at a discount rate. Once those assets sort of get fully priced, the money starts to slosh into secondary and tertiary assets that are a little bit more speculative. And I feel like that's where we're at now.
Okay. All right. And this is not a great picture for increased GDP. It seems like I've heard the savings rates at a record high. Is that also part of low velocity of money, that consumers aren't really spending, they're saving, they're paying down debt? Is that part of it?
Yeah. So I'll comment on this, and then I'll make a
Okay.
comment on some of the cyclical trends, which I feel like are also important. So there's a couple things to look at with the savings rate. So there's the personal savings rate, which is what a lot of people look at. But then there's also something called the net national savings rate. And the difference is that the net national savings rate is the combination of government savings or dissavings if we run a deficit, personal savings, and corporate or business savings. The personal savings rate's very high, but the net national savings rate's negative. So why is that? It's because we're not actually generating any savings out of income. We're generating savings from government dissaving. So the government is borrowing money, handing it to people, and they're paying down debt or saving it or putting it into stocks and financial assets. So the government dissavings and the personal savings is totally offset, and that's in the metric of net national savings, which is negative. The difference is in the 1940s. The 1940s had extremely high net national savings, which is how we got out of the debt problem of the Great Depression. We continue to hear the analogies to the 1940s, but the situation is incredibly different in the sense that we had a 25% personal savings rate, but the net national savings rate was about 15%, which means that we were saving out of income. So if you go down to, um, if you go down to uh, this chart here on the top right, this chart shows federal government transfer payments as a percentage of total spending. So of all the money the government spends, how much goes to transfer payments? In the late 40s, early 50s, about 20% of every dollar the government was spending was going towards transfer payments, which is what we think of Social Security, Medicare, Medicaid, and stimulus checks.
Right.
So 80% of it was actually going into what's called consumption expenditures, which actually is accretive to GDP. That's changed. This has been a secular shift where now 65 to 70% of every dollar the government spends goes towards transfer payments. And that has a really, it has a very negative impact on growth, because if I borrow money and I send you, Dale, a dollar, you don't have to spend that dollar. And if I borrowed money, the debt goes up, I send it to you and you save it, debt went up, growth didn't change. So we continue to do this over and over, and our debt burden continues to rise, but people aren't taking that money and spending it into the economy, because there's a concept in economics of, if I get a one-time payment, that's not going to change my outlook very much. I need a permanent shift in my future income curve to really change consumption, and constantly handing one-time checks to people isn't going to make a material shift in my personal income curve out.
Is that part of the argument for like MMT and give universal income?
That is the argument. We could discuss MMT. There's, in my opinion, a lot of misconceptions around what that means,
Okay.
and how it's done. So
I'm going to stop interrupting you, Eric, but maybe because I know you have a lot to say, and we'll do more than one interview. I'm
Sure.
wondering if we could just, besides your all of your fundamental insights, and they really are interesting. What it means to us today, not as traders, but as investors, and is your work saying that we should pare down on risk? Kind of, you talk about the next 2 to 3 months.
Sure.
I know a lot of people that are cycle guys that think
Yep.
that we could have a pretty good correction in the stock market. And that's a minority opinion right now, because people have been crying wolf forever, right? So
Right.
I'm wondering what things that might be actionable that could help people, guide them through the shark infested waters over the next quarter or two, what you're seeing.
Okay. Excellent. So
Okay.
as these are the secular trends, and what the secular trends do is they give you a bias of where's the gravitational pull in the economy. But there's also cyclical trends and how the cycle moves. The cycle tends to start with the Fed moving monetary variables like interest rates, and then that impacts cyclical sectors. The most cyclical sectors are manufacturing, housing, and big ticket consumption like appliances, cars, because those are the sectors that are most sensitive. They're typically bought with finance arms and things like that.
Yeah.
And just skipping through all the way to the end here, something that I provide in some of my writings is sort of a dashboard of some of high level cyclical indicators. We go in pretty deep, but if you just take a look at the cyclical indicators, we're still trending higher on all of the indicators of those sectors. So we shouldn't expect the manufacturing, housing, or durable goods sectors to turn down in the next month or two. There's still some strong cyclical momentum going on underneath the hood. So as long as the economy is trending higher, risk assets tend to perform well. So we hear a lot of, well, if yields go up, the economy's the stock market's gonna correct, and that may be true. Like we saw that a couple of weeks ago, where the bond market got a little disorderly and the market corrected, and people were calling for yield curve control. But what we were saying was, this is going to be a short-term phenomenon because the economy is accelerating, growth is accelerating, and as long as growth accelerates, risk assets do well. So we've seen 10-year yields go from basically 50 basis points to 150 basis points, and the stock market has, if you take the longer term view, ripped in the face of that. And that's because the underlying trends continue to move higher. So I put together a little dashboard here of what to expect when the economy is accelerating and what to expect when the economy is decelerating. So since the economy is accelerating based on those cyclical trends, which is counter to the long-term view, but that's sort of what we have to balance, you want to be working with the left side of this chart, which is why value has been outperforming. So when the economy is accelerating, materials, industrials, financials, energy, small caps, international, those are the things that tend to outperform. You don't want to be heavily overweight long duration. Interest rates tend to rise when the economy is accelerating. You want to be long your industrial commodities and oil. I heard some comments in the beginning that silver acts better than gold, or in some of your charts that silver was acting better than gold. That's totally in line with the fact that the economy has a short-term acceleration. So silver tends to be a little bit more industrial than gold, which is why your industrial commodities will outperform.
Copper. Yeah,
exactly. Right. And that's why we've been such strong rallies in there. Now, when our indicators turn back over and we start to see a clear deceleration in the economy, which I would expect in quarters to come, which is where the secular trends come in. The secular trends tell us that the gravitational pull in time will pull these down. We don't have a secular shift where the economy is going to accelerate forever. Like one of the panelists was saying before, that we've solved this debt problem forever. It's not the case. We will turn back down in due course. And when we do, you're going to want to shift over to the right side of this dashboard and get back into your.
What's your best guess how long this expansion and central planned economy lasts before we turn down again? Did the Fed buy us 2 years?
No. I don't think it'll be 2 years. I tend to have a rolling outlook over the next couple of months, and I can tell you that we're not going to turn down in the next month or two. But we'll check back in the late summer, August, let's say, and then we'll have a better idea of what the back half of the year is going to look like. But when we do see the indicators turn over is when you will want to shift back to your defensive assets, and when interest rates will start coming back down again, because we have not made the secular low in interest rates. We'll continue to grind to lower lows as long as
negative rates, Eric.
As long as this chart continues to trend lower, interest rates will follow. Negative rates will be determined if the Fed adopts negative rates. We won't be able to be in a situation really for the 10-year rate to go negative if the Fed doesn't want to move the overnight rate negative. But what tends to happen, what happened in Japan and what happened in Europe is conditions weaken. The 10-year rate sort of compresses right on top of the Fed rate. So let's say the 10-year rate is 0, the overnight rate is 0. A flat curve sort of starts to kill the banks. So the Fed's sort of stuck in between a rock and a hard place. And usually they give in and try and steepen the curve by going negative, which as we know, doesn't really work that well. But I think it's a possibility, sure. As long as this chart continues to trend lower, then rates will trend lower. But we do have a cyclical upturn. So
there's some people talking about GDP at 8% by the end of the year.
Yeah, and this is a longer presentation. I can send people the slide deck if they're interested. They can shoot me an email. I'll put up my contact information. But we go through all of the different sectors, the housing sector, and we have such a big pop because of this pent up demand that this is a chart of real residential construction spending growing 32% annualized over the last 6 months. Of course, this won't be sustained at these rates, but in the meantime, we have very strong upturns in a lot of these sectors, which I sort of try and pick up in this dashboard and say, hey, when these indicators are all ripping higher, you have to respect the cyclical upturn despite how strong the secular downturn is, and say that, risk assets are going to perform better. You're going to want to work with the left side of this.
Let me ask you this, Eric. Were you surprised that the housing market, as far as price appreciation, in many areas of the country surpassed the peaks of 2008?
I was not surprised, because what's interesting is if you price housing in gold terms, it's actually at an all-time low. And this is also similar, not exactly with stocks. And what we see is that a significant portion of the price appreciation has simply been the interest rate effect. So if housing, you have to sort of normalize for the fact that if 30-year fixed rates were 5.5%, and now they're 2.5%. If you standardize for that interest rate effect, home prices haven't gone up all that much, which is consistent with growth. But if you lower the interest rate by 300 basis points, there's going to be a price impact. You're going to be able to carry a more expensive house with the same monthly cost. So when you price
is this a
assets in
housing
gold,
bubble 2.0 developing if we get higher yields, and you're wrong about a move back down to 0.50? What would cause in an environment like this, where they keep talking housing shortage, any kind of real estate problem, do you think?
well, we'll have a price correction in real estate for sure. Like as we've seen, so in these indicators here, one of the indicators I have on the right is the 30-year mortgage rate, which will obviously give us some insight into the housing market. It's graphed inverted, so when it's going down, the mortgage rate's going up. So the mortgage rate is going up, and we've seen some cooling in some economic data like new home mortgage applications and things like that. So if mortgage rates do continue to creep up, then we will have a correction in home prices again from that interest rate effect. But I don't expect it to be a systemic issue like it was last time, because we're not using as many adjustable rate mortgages, mostly are 30-year fixed. But I completely foresee a correction in risk assets as economic growth continues to trend lower. So yeah, I do expect home prices to come down, as I expect stock prices to come down, but only when we have a renewed cyclical downturn in the economy. I don't expect asset prices to come down while the dashboard looks like this.
Yeah, the question is in nominal or in real terms.
That's a good point. Exactly. So pricing assets in gold gives you a good standardization for the real or nominal terms. Which interesting is if you price the S&P 500 in gold, we haven't made any progress since 1997. And if you try to stack it up with our long-term charts here, it sort of makes sense why that would be the case.
Yep, absolutely.
All right. Well, if you have Steve Voulge saying yes and asking you fundamental economic questions, you've and that he's interested in what you're saying. Wow, you win a medal today, Eric. You win a medal. Go ahead, Steve.
So, Eric, in plain English for people, how do you see this phase unfolding down in the future?
So what I would forecast to happen is that the Fed will remain dovish, mainly because they have no other choice.
Exactly.
Eventually, this cyclical upturn that we're experiencing, this pent-up demand, will fade, because we have a big shift of people moving from cities to suburbs. That causes a lot of housing demand. That causes a lot of people to purchase new items, and it does give the economy a short-term boost, but that will fade in time. And then the economy will turn back lower again, and the discussion of tightening and tapering will quickly go away. And I foresee that we'll be stuck in a situation similar to Europe and Japan, where the short-term rate is held at zero. The long end of the curve starts to come down towards zero, and then the discussion starts to move into the realm of, do we go negative or do we not? And it may take a correction in asset prices, but it will be a tough situation to avoid some sort of negative interest rate. It may not be legally feasible with the way the Federal Reserve Act is currently structured.
The vast majority of things central banks do are not legal in any case. I mean,
exactly. Yeah. So there will be some workaround that they'll have to come up with, whether they charge a fee on deposits or something, but they'll have to manufacture some sort of negative interest rate if they don't want the real interest rates to start going up.
Yeah, although the only part I disagree with is the comparison with Japan and Europe. With the exception of a few countries in Europe, I think that the US would love to become Japan or Europe, because I see a lot of issues.
They have trade they budget surpluses or trade surpluses rather than deficits. Is that why,
Exactly.
Steve?
And for example, in the case of Japan, the vast majority of the debt is held, by
By them.
locals,
Yeah.
so on and so forth. So I see the US being in a totally different trajectory than becoming Japan. I think that would be a very, very good outcome in comparison to what can happen.
One comment on that is that we're the world's reserve currency. So as a reserve currency, we have to run deficits. You basically can't be a reserve currency without running a deficit because you have to supply the world with your currency. So it would be very difficult situation. I mean, the deficits that we're running are quite large, and it does have a deleterious impact on our growth. But in some ways, it's a positive because we've been able, if we were to use the debt properly, we would be able to finance construction of our country with other people's money. We haven't used that debt properly, and we've tended
you never
to throw it
will
away.
because it's not the politically attractive thing to do with debt.
That's correct, but I don't foresee the problem. You know, a lot of the U.S. does run a twin deficit, which is problematic for many emerging market countries, but we're the world's reserve currency, so definitionally.
For how much longer, Eric?
Yeah, that's the thing.
That's not gonna change because there has to be someone who can replace it. And right at this point, there's no one that can come close to replacing
the IMF.
No. That's
no.
no.
Okay.
No, the U.S.
I'm glad I have a lot
there's
of
not
cash.
There's not a main competitor to the dollar as a reserve currency.
No digital yuan or anything like that.
You know, we talk about the problems in the United States, but China doesn't even have an open capital account. So, you know, we talk, if our trade deficit's a problem, they need a rule of law first. The trade deficit issue
I
is
agree with
valid,
the thing with China, but on the other hand, you know, we live in times that there are other solutions than a single currency. And oppositely, one way or another, we've had many world reserve currencies in the past, and none of them stayed as such forever. Why? Because history, you know, makes circles in essence, and what happens is that you get a very prosperous economy doing the right things, and that's why it becomes prosperous. Then its currency is accepted as the world's reserve currency. Of course, you know, the definition of the world has been expanding since that started happening. Of course, it can't expand anymore since, you know, we've explored all Earth and inhabited all Earth. But the thing is that then the economy that has the world reserve currency is taking advantage of that fact and gets derailed in the way it does business and it does things, until in essence that currency loses value and faith is lost in it and something else replaces it. So I really see all the signs of that trajectory in the US and how it handles its economy.
I fully agree with everything you just said. However, at this stage of the game, there's no currency right now that can fulfill all of the roles that the US dollar fulfills. There's still something like 85% of world trade is still conducted in dollars. You'd need to find an example. You know, I'm sympathetic to the idea that the dollar can lose its reserve currency, and it's a fun conversation to have, but we need to propose what's coming. Give me an example of how we're going to introduce a new reserve currency, and then we can start to move.
The IMF, you know, with their SDRs is kind of like a plan B, isn't it?
I don't think there is any politician honest enough to go back to what would enforce proper economics, which is back to the gold standard, right?
I don't think that's possible. Yeah, I agree.
I think it's possible, but politically, it's
right. Politically, it'll never happen.
Exactly. Anyway, Eric, you want to put up your website because we have to wrap here. You know what? I'm so glad our paths crossed because you know
so
what?
You can find me.
It's going to be an interesting debate every time you're on with Steve.
Yeah, that'd be great. So
yeah.
You can find me epbmacroresearch.com. You could also find me on Twitter. I have a couple of YouTube videos. I popped up my website here, epbmacroresearch.com.
Okay.
I have some free research that I post that you can go on and read. I also have a couple premium products. I have a monthly report, which I cover those cyclical indicators only, just cyclical indicators, sort of give you an idea of are we accelerating or decelerating. And then once a quarter, I also give that quarterly presentation, which some of the slides we just ran through. That deck
Do you
that I was
trade,
going
Eric, or
Uh,
invest?
I do invest. Nothing I do is on the short-term time horizon. So I'm mostly in the
Okay.
6 month and beyond camp, but I'll
Okay.
leave the shorter term stuff to you guys. I encourage a lot of people to use my research in conjunction with stuff that you do, because I can give you the cyclical trends and the secular trends. I could sort of give you the bias of
yeah.
the bias of
Yeah.
where we should be, and then if people want to use a more technical approach
Yeah.
to sort of take a tactical entry and exit points, that's
Well,
great.
even though you don't trade, you survived an interview with me and Steve Volge. You're
that was a
now
good
our
time.
trading. You're now our trading warrior brother.
I love it.
Like it or not, it's a
I love it.
lifetime. It's like being in the mafia.
Thank you very much, mate. Very nice presentation.
No, I
Yeah,
appreciate
very
it.
nice.
Thank you very much.
Yeah, Eric, thank you for your time and sharing your wisdom with our community today. And we will have you back. Okay, bro?
I appreciate that. Thanks for having me on.
All right, everyone.
Have a
That's
great
a
day.
wrap. That's a wrap. And Steve made the interview go long, so he has to write the tagline. And don't forget, don't forget to join Blake and the team on the Morning Edge in 6 minutes, man. So you just have a little time to go to the bathroom if you have commodity
And brush your
kidneys,
teeth.
and brush your teeth and go into the room. All right, guys, that's a wrap. Don't forget, don't just count your pips, count your blessings, and we'll see everyone to wrap the week tomorrow. Thank you, Steve.
Bye
Great
bye.
interview. Good job.
Thanks.
All right, see you, Eric.
Bye.